Welcome to The Man from Macro, where we look at some of the big themes in today's global markets. This week we again look at the stickiness of US growth and the probability that the Fed will end up out-hawking the other major global central banks. The latest data point to surprise on the upside was US inflation. The market then swiftly moved to price out more of the rate cuts that were expected this year. You may recall that last week the Fed funds curve was implying approximately 100 basis points of rate cuts by the end of 2024. After the CPI data, this has fallen by about 12 basis points, or the equivalent of half a cut. That might not seem like much, but we came into the year with as many as 7 cuts expected by the market. It's now around 3.5. Despite the initial decline of 1% by the S&P 500, the US equity market remains close to the all-time highs. This makes sense for a number of reasons. Firstly, we are only skimming off the excess rate-cutting expectations of the market. The Federal Reserve's dot plot anticipated 3 cuts in 2024. The market, at 3.5, is therefore still more optimistic than the Fed. Secondly, we are not going to see the sort of step change in rates that we saw in 2022, even if the Fed had to move back to a hawkish stance. On an absolute basis, that was the biggest change since the 1970s. This massive change in interest rates led to the re-rating of US equities, although the ensuing 20% decline in the S&P was a remarkably orderly bear market. There is far less scope for an extreme shock today. And even if the next policy move is a rate hike, it will take many months of stronger data for the Fed to unpivot the pivot. Thirdly, if the US economy is rebounding, then that supports the ongoing inflows from things like 401k funds that have been an almost constant market bid for US equities during the last decade. And as we have seen before, recessions have historically required a surge in unemployment to trigger a recession, and it's usually only then, with the increase in unemployment, that the equity market creates a tradable low either during or through the recession. Whilst today's post-COVID employment data is heavily distorted, so that low rates of unemployment and initial jobless claims do not necessarily mean that the jobs market is strong, it will still require a widespread and simultaneous reduction in headcount to create the conditions that lead to a recession and a slowdown in the 401k flows. When equity markets are still rising, corporate leaders tend to hoard jobs. Therefore, more success in the equity market could be the very thing that forces the Fed to return to a hawkish bias. For currency markets, the Fed just needs to out-hawk the other regions. Therefore, a Fed on hold may be sufficient to keep the dollar on the front foot versus the other majors, such as the euro and the Japanese yen. The yen has again been testing the 150 level versus the dollar. Although Japan's policymakers have been taking note, they shouldn't worry too much as long as the dollar does not surge. But for now, the US economy appears to be more resilient than Japan and Europe. For the US equity market, the economic window therefore remains constructive. However, there are a few elements that warrant caution. Index volatility has been edging higher with the rising equity market, partly because of the impact of structured products. We saw similar activity ahead of the S&P 500 volatility event of February 2018, when the index fell 10% in a few days. Structured products are an even bigger component of today's markets than they were then. Investors will be keeping an eye on this dynamic, given the rise of structured products and short-dated options within the market's landscape. People should therefore be aware of the quarterly expiry on March the 15th. Expiries themselves are not a cause for concern, but the volume of rolling and re-hedging that might take place through this event could easily lead to an increase in market volatility regardless of fundamentals. That said, please remember, none of this is investment advice. These are just observations for educational purposes only, and everyone should be aware of their own investment objectives and risk profiles. But thanks for watching.